The bullish sentiment being intense. In this report, we aim to shed light on factors driving WTI's price and assets future outlook. The US oil market tended to show signs of easing in the past week. It was characteristic that the number of active oil rigs in the US dropped to 540 if compared to the prior reading of 545. Furthermore, it was characteristic that the API weekly crude oil inventories figure showed a rise of US oil inventories of 3.026 million barrels. The increase of oil inventories was also confirmed by EIA as the agency reported an even wider increase of 5.946 million barrels. The releases tended to reverse last week's reported drawdowns and imply the existence of a slack in the US oil market as demand was not able to catch up with production levels, while the reduction of the number of active US oil rigs tends to foreshadow a slowing demand. On the supply side of the commodity, we note that the announcement of Saudi and Russia oil production cuts tends to intensify worries about supply shortages and remove some of the uncertainty regarding the downside risk of oil's price. Hence, the cuts tend to intensify the bullish sentiment of the market. Without having a direct impact on the oil market, we would like to also note headlines mentioning the Saudi Arabia imported record Russian fuel, allowing thus for an export of Russia oil, yet at the same time through controlling the outflow of the commodity even further and in a more direct manner. Reports surfaced this morning that China's June crude oil imports soared 45.3% year-on-year, boosting the bullish sentiment for oil as China is one of the main consumers of oil globally. It seems that Chinese refineries are building up inventories, yet demand does not seem to follow yet. The economic recovery of China seems to be slow and under doubt that may ease market expectation for the demand outlook for oil. We're highlighting that the manufacturing PMI figures showed another contraction of economic activity for the Chinese manufacturing sector in June, a scenario that may not have positive effects on oil. Furthermore, it seems that both the export and the import growth rates slowed down for June, and despite the trade balance being allowed to rise, China's trade data tend also to point towards reduced economic activity. We highlight the release of China's June industrial output and Q2 GDP growth rates, and a substantial slowdown could verify further the economic slowdown, with possible adverse effects on oil prices. The release of US data for June tended to enhance traders' hopes for an easing of the Fed's aggressive hawkish stance. It was characteristic that the core and headline CPI rates slowed down more than expected, which tended to intensify market expectation for an early end of the Fed's rate hiking path. Should that be the case, that would allow for US economic activity to pick up and thus possibly increase demand for oil in the US, boosting its price. Furthermore, we have to note that the weakening of the USD since Friday may have allowed for the commodity's price per barrel to rise. Yet we note that the de-dollarization of the oil market may ease the phenomenon in the long run, and should it be achieved. Thank you for watching.